In this video, guys, I'm going to answer the question, if my daily trading plan is always wrong, what's the point in even doing it? Stay tuned. Hey guys, so question from a day trader here. My plan is always wrong, so what's the point? In other words, I go into the day, I've planned out the trading day. I say, okay, well, I expect this to happen at the open, then I expect perhaps the price to test this level, that level, etc. Assume they're trading one specific market, but then the idea is, okay, I've planned what I want to do, but actually most of the time I'm wrong. So what's the point in doing a plan? And you know, logically, it makes perfect sense, right? If the plan is completely wrong, then what's the point in doing it? However, it's well worth doing a plan, and let me explain why. Because number one, the process of doing the plan is a big thing. It's the discipline, it's the muscles of saying, okay, what's the market doing? Right, I'm looking at the market now, here it is, and I've seen it yesterday, push up to highs, pull back, and kind of close right in the middle. And I'm on now day two here, and I'm going into the day and I'm looking at the day. So most of us would say, all right, so we've got, you know, a decent level of resistance up there, level of support here, ATR will be expected to be that. So we could kind of position here or position here potentially, depending on what the ATR is doing, etc., etc., etc. And so we may then split it up into segments. We might say, okay, well, at the open, maybe if we drive up here at the open and stall very quickly, I'll take a short here. And we start to hypothesize. We start to say, well, I'll short here if the ATR is this and X and the other, and we start putting statements together. If not, then I'll look to kind of buy a breakout later in the day. If we start to test that at lunchtime, I'll buy it for a move up to potentially there, etc., etc. So you start to structure, and what this does for you is it starts to cement A, the levels that are of interest to you, B, it starts to help you think of where the market could go, and you start to put together perhaps a roadmap. Now the argument for this chap is that, hey, the roadmap's always wrong, but the point is, guys, is that you're adapting to as your hypothesis change, and this is how trading is. It's a case of, right, this is what I think is going to happen, this is what is going, this is now what is happening, what can I deduce from that? It's very difficult if we don't have a benchmark to decide anything. So if we decide that, hey, you know, that it's bullish if we get above that high, and it doesn't get above that high, what are we deducing? We're deducing that it's relatively bearish still because it's held below what was actually a pretty decent high. And so if we hadn't had that plan that said, okay, it's bullish above that high, I want to go long, then we wouldn't be positioning short and looking to fade things that are struggling there because we've got a decent risk reward ratio. We might even be completely the other way around and saying, well, it's bullish because it's driven up hard from here. Where in reality, we've set it and we said, okay, well, it's bearish because it's still below that level. Now, that might be right or it might be wrong, but very often, guys, unless we have an anchor point to work from in our trading, unless we have some kind of thesis of, yes, I expect it to be a rotational day and I expect those are the kind of levels we stop and stall at, then it's very difficult for us to adapt and change, and we flip-flop back on the other and we end up kind of just doing anything we fancy. So if it's very clear early on that, hey, this is looking like a trend day, then let's scrap the plan. Let's say, okay, well, let's not start fading anything, let's just buy this pullback. Evidence suggested that, you know, it's blasted through my levels, it's holding at highs, it's doing all the things that may look like a trend day, then won't use that rotational plan. But the point is, because you've looked at the market through the lens of I'm going to trade rotationally, you've then categorized it quicker and said, okay, it's not rotational, it's now looking more trend. Whereas if you went into it without any idea, you might be looking to short it all the time. Maybe, oh, it's high, it's too high, I'm going to short it, I want to fade it, and it keeps ripping and ripping and ripping. And you haven't got a reference point to kind of judge it against, if that makes sense. Having that plan is so crucial, and it doesn't matter if it's wrong consistently. The fact that you have the plan, you have the levels in, you have the areas you expect, what you think is going to happen, even if it blows through it, then that's great because you can adjust and you can adapt. Now, what we don't want to do is just be blindly trading at the key levels. We're looking at the areas we want to do business, the type of price action we want to see before we enter the trade. Yes, we're going to get stuff wrong. That's what stops us for. That's why risk reward ratios are the way they are. But the point is, if we have some kind of roadmap, we can adjust and adapt. Oh, it's a dead end, it's not going there. Let's go around the other way. Let's look at it from a different light. Let's look at it like this. So we have that structure to build on. The The process of doing a plan is so valuable, guys. It's the discipline of sitting down and analyzing and preparing and deciding the size, deciding where the market could go, all this kind of stuff. That instills good habits. And if you constantly doing that, you're at the screens early to come up with a trading plan, come up with ideas, if it's specific market or you're screening, whatever, then that only is going to help you, even if, as this points out, it's completely wrong all the time. All right, guys, take care, and I'll see you in the next one. Bye-bye.